Hello, this is MyTam Television exploring United States stocks. Today, in our United States Blue Chip Stock Analysis segment, we'll be covering a company called Generac Holdings. The ticker for this company is Generac Holdings. This video is being broadcast simultaneously on our channel, MyTam Television, through a partnership with Mijihun Television. If you haven't subscribed to the MyTam Television channel yet, please search for it and subscribe. I would really appreciate it. Generac Holdings is a company that makes emergency generators for homes and businesses. In other words, it's a company that manufactures generators that produce electricity. That's how you can think of it. Let's review data on Generac Holdings to assess if it's a good company, check its valuation, examine supply and demand, and consider future stock price movement. We'll analyze each aspect step by step. If you look at Generac Holdings' stock price trend over the past year, you can see that it has experienced really sharp ups and downs, almost a V-shaped rebound. Compared to its peak, it dropped by 50%. Then, from the low point, around $100, it surged almost twofold. We've seen these kinds of movements. So this company's stock can really drop and rise sharply. Would you be able to hold on to it if the stock price fell by 49%? It's not easy, right? Selling and seeing the price double can be very frustrating. It's important to realize this company is highly volatile. As you can see here, the stock price was cut in half, but now it's gone back up to about its original level and is currently going through a correction. So we need to pay attention to whether it will break through the previous high or not. However, recently, as the stock price surged, the gap between the current price and the existing moving average line has widened significantly. Since the gap has widened a lot, it seems likely that there will be some period of adjustment. So depending on how the stock price moves during that period, it could break through the previous high and go up, or it could undergo a bit more adjustment. From a technical analysis perspective, it seems we've reached an important point. I'll briefly talk about this company and then analyze the data. This company mainly focuses on two things. It specializes in producing residential generators and commercial and industrial generators. So it's a company that generates electricity, and it's currently seeing a significant increase in new orders due to the expansion of artificial intelligence data centers. So I think it's worth paying some attention to this company. If you look at this company's name, you'll see that the front part is like generator, and at the end it says alternating current. Alternating current is what we use for alternating current in electricity, right? So that's why it's called generator alternating current. So it's a company that produces electricity, and that's reflected in the company's logo and name. So when do we use it for residential purposes? For example, we might keep emergency generators at home, but in Korea there aren't many people who actually have emergency generators in their houses. Even in the United States, the penetration rate isn't very high, but for example, when a typhoon, hurricane, or a major disaster hits, there are many cases where electricity isn't supplied. But people need electricity and water to live, right? So, in these situations when there's a power outage, emergency generators quickly supply electricity so that households can continue their daily lives. That's the role of emergency generators. It's for residential use, so these are often used in homes as portable devices or even as chargers, like when charging electric vehicles. So residential emergency generators are only used in about 6.5% of the entire United States market, which means there's still a lot of room for growth. However, because these are for residential use, the profit margin remains low. Compared to commercial or industrial use, the profit margin is lower, but it can significantly help increase the overall sales size. Second, we need to closely monitor commercial and industrial use now. This part is important because of the expansion of artificial intelligence data centers. If you look at companies these days, you can see that a lot of work is being done through artificial intelligence. But sometimes if artificial intelligence suddenly stops, or if it needs to connect to a large language model and it stops, the service itself can come to a halt. The reason the large language model stops is simply because the power goes out. There could be errors as well. That's why it's really important for data centers and artificial intelligence systems to have backup generators and systems that can continuously produce and supply electricity for a certain period of time. This is especially crucial for artificial intelligence data systems. If electricity isn't supplied, we can't provide LN, which would severely hurt our sales and other areas. That's why stable electricity is crucial. So not only artificial intelligence data centers, but also places like hospitals and other areas where a lack of electricity can be very dangerous, use a lot of these products that produce generators. These aspects are also expanding into artificial intelligence data centers. In the case of this company, if you look closely at this picture, to put it simply, the square shapes represent the factories. So this becomes the artificial intelligence data center, it becomes the data center, and this is the generator, this is the generator, and then through these, when a problem occurs in the entire data center, this is called the grid system, and here you have something like software, the microgrid control system. The moment it determines that the power has been cut off, it immediately supplies emergency power. So it instantly provides emergency power and produces and supplies the electricity needed for that emergency power. So if you look here, it says energy storage system, which stands for energy storage system. This is the battery, this is the generator, and then this is the grid system that manages them. And this is the data center. That's how you can see it. So these three things down here are combined as one integrated set and provided as a package. Companies that can offer this as a package are considered highly competitive. It's not just about providing a generator, but also about playing a role like a brain that can control everything through a smart grid system. When something seems wrong or unstable with the electricity, the system quickly detects it and supplies power through the battery storage system first, then runs the generator to provide a steady and reliable supply. These are the kinds of stable systems being offered. This company, Generac Holdings, accounts for about 32% of the total sales. Residential use makes up 57% but has low margins, while commercial and industrial uses have higher margins. So, the expansion of artificial intelligence data centers in this area could be a significant growth driver for Generac Holdings. That's not just my opinion, it's what the company's president said. The chief executive officer actually mentioned this in business reports and other places. Something significant occurred during this year's Q2 earnings announcement. While the stock price surged, their earnings report revealed their data center order backlog topped $150 million for the first time. Previously, they hadn't disclosed the backlog or details about data center orders. It wasn't even that big before, but in the second quarter earnings, they commented on this as a very important point. So the data center order backlog increased by $150 million, and this order backlog will mostly be reflected as revenue in the second half of this year and next year. Here's the order backlog. Next quarter, we'll check how much orders have increased again. So this order backlog is called a backlog, and if this data keeps increasing, it's highly likely that the company's performance will improve. That's why I think it's good to keep an eye on this backlog data. In April this year, they launched new large capacity generators from 2.25 megawatt to 3.25 megawatt. This is a new product, and it's a major high capacity generator that will be supplied to artificial intelligence data centers. To give you an idea, 2.25 megawatt is enough to supply electricity to about 1,125 apartment households at the same time. A size of 2.25 megawatt is enough to supply power to an entire shopping mall or even run a typical factory. So this company has product lineups up to 3.25 megawatt, and with those we provide solutions that can always supply stable electricity even in the threat of power outages through emergency generators. And this is just a minor point, but still. This company announced NVIDIA as one of its major clients, so we also sign contracts and supply these products to NVIDIA. So I think it's something we should definitely keep an eye on. And as for whether it's a blue chip company, it scores 70 out of 100 and overall. It's in the top 11%, so you could say it's a blue chip stock. If you look at the Pentagon chart, overall it's pretty full, but the growth section is a bit lower compared to the past. It would be good to take a closer look at this part later when we discuss future performance. Overall, it's in the top 10%.
It's a blue chip stock that belongs in that category.
That's how I would assess it. If you look at the financial chart, this company tends to be affected by seasonal performance on spring, summer, fall, and winter. The data below is just the annual data I brought in. Recently, the results up to the second quarter of 2025 have been released. But the reason I brought the annual data is because profit for this company shifts significantly with sales changes and fluctuations. When sales rise, profits grow rapidly, but if sales stall or drop slightly, profits can fall quickly. It's important to remember that. It belongs to a typical cyclical company. Recent Q2 sales were $1.06 billion, just a 6% increase from last year, showing little growth. However, the earnings per share is up 22%, so it's currently rising much faster than sales growth. And especially if you look here, it's not really a high margin company. The operating profit margin was about 15% in the past, so compared to other American companies, it's not especially high. It's not a high margin company. And in 2022 and especially 2020, the margin dropped significantly. The operating profit margin fell from 15-17% to the low 10% range, a sharp drop of 8-10 percentage points. Although sales increased, overall operating profit fell, and the company has been working to recover those sales figures. So as sales recover, the profit margin is also recovering, and there are periods where the profit growth rate is higher than the sales growth rate. If we look at the reasons for this, the decline in profit margin in 2022, as I mentioned earlier, was mainly due to the increased proportion of residential products, which we can call Jomhwajin. This had some impact, but an even bigger factor was the fluctuation in raw material prices. So in order for this company to make these generators, they need a lot of materials like steel, copper, and aluminum. The sharp rise in raw material prices, along with issues in the global supply chain after COVID-19 and many other factors, led to an increase in costs. These factors greatly raised the cost of goods sold, with about 70% coming from raw materials and parts for this company. So they can't avoid the prices of steel, copper, or aluminum, which means they're heavily affected by these fluctuations. So tracking how raw material prices change will help you estimate this company's profit margin. But in the past, we've only looked at it as an index. Originally, you would need to calculate everything by price, by item, or by the proportion of each raw material to be accurate. But for now, I've just brought two main categories. Non-ferrous metals mostly refer to things like aluminum and copper, and steel is based on the steel index. If you set the index at 100 for 2020 and see how it changes by 2022, it becomes 170. Steel and non-ferrous metal indexes both hit 165. This means raw material prices rose by 65 to 70%. When prices rise, you must increase product prices, but since much goes to housing, it's hard to pass on costs. So as the cost increased, it played a big role in damaging profit margins in this area. Comparing 2022 and 2025, the figure dropped from 170 to 160, and for non-steel from 165 to 150. So at this point, there's no further risk of additional cost damage, and after the drop, raw material prices have decreased a bit. Once things stabilize, one key point is the improvement in profit margins that comes from there. Another point is that generators for data centers and other industrial uses have relatively high profit margins. So when those margins are added, the sales growth rate
Is low, but the earnings per share
growth rate can appear somewhat higher than that. So we can say that the environment for that has been established. The inventory turnover days have recently decreased, but it's not just low at this time. It used to be at that level in the past, and now it's returned to that level again. We can say product sales speed has returned to previous levels. Next, if you look at the cash flow, operating activities are positive, investing activities are negative, and financing activities are negative. So with positive, negative, and negative, you can say that it has the cash flow pattern of a very solid blue chip company. The cash flow from investing activities is nearly stagnant. So what this means is that the company hasn't made any additional M&As or other investments. So we can see that this isn't a structure where they need to keep increasing tangible assets through investing activities, and even if production increases, it's currently possible without additional investment. That's how we can interpret it. Cash outflows from financial activities like debt repayment or share buybacks are recorded as negatives and can indicate financial soundness. If you look at the stock price and earnings per share chart, I drew this arrow showing a sharp drop in the stock price. Now, will the stock price just stay at this level? That would be quite unreasonable. Because as I often say, the stock price is the shadow of the earnings per share. So if the earnings per share is rising like this and it goes up by about 15 to 20%, it's not easy for the stock price to just stay at this level. So if there's just one momentum or catalyst that could make the stock price surge, the period when earnings per share is rising, but the stock price keeps falling is exactly when a surge could happen. It's really frustrating. You might have thought it was cheap here too, but the stock kept dropping. So, is the company not growing its earnings per share? That's not it either, but there needs to be a turning point. By checking supply and demand, you can at least avoid holding on to things that will frustrate you for long. Now we can see that the stock price has risen enough to follow the earnings per share. The ChoiceStar app is now available. We offer Android, Apple and iPhone versions, so you can access everything after downloading. By setting your interests, you'll get the latest breaking news from earnings season and electronic data gathering, analysis and retrieval. You can see all the analysis in Korean and the artificial intelligence analyze materials within about a minute. You know, it would be good if you could try using that as well. And if you look at the expected earnings, like the sales figures aren't that high. Next year, it's 7.8%. Then 8.2% the following year, so growth is around 8%, but profits are growing even faster. As I mentioned earlier, the cost ratio, since steel and non-ferrous metal prices have stabilized a bit, there's an improvement point there. Second, since artificial intelligence data center power generation systems already have high margins, any profit margin improvement there has a significant impact. Since earnings per share is growing about 25%, this is a moderate growth company. So although earlier I gave it a score of 0 for growth and its sales growth is quite low, if you look only at profits, it's still a company that deserves a mid-range score, around 40 to 45 points. I think interpreting it this way is a bit more reasonable. If you look at the valuation, over the past year, the red color indicates expensive prices and the yellow area shows certain price levels. I think that yellow area probably corresponds to the time when the stock price dropped sharply earlier. At that time, if you look, there was a period when it even reached the dotted line indicating it was very undervalued, and it stayed there for quite a while, not just briefly. From a valuation perspective, that was when the company was the best to buy. Now the stock price has risen sharply, and if you look at the recent stock chart, it has gone up by 90%. From here to here, it increased by 90% and the stock price rose in a straight line. Right now, it's reached about a fair value, not extremely overvalued, but at a fair level. Since it has surged in a short period, there's a possibility it might go through a period of adjustment. However, if you look at the long-term picture and keep an eye on the performance through things like artificial intelligence data centers, I think it would be good for you to look for good opportunities. From a technical analysis view, the exponential moving average midterm chart shows a breakout above the 20-day and 60-day lines in May.
Right now, the world is...
Recently, the 60-day line has crossed above the 120-day line, so there could be some corrections, but the chart pattern from a technical analysis perspective is showing a form that strengthens the upward trend. That's how we can see it. Let me move to our service, add a few more words briefly, and then wrap things up. Looking at this company, the buy signal came out very quickly for us this time. It came out quickly, but in the past, in 2023, we took a loss, about 10%, and in the second trade, we also cut our losses with a 6.6% loss. And now, after buying at $127, we're seeing about a 52% return. So compared to 2023, the stock price is at a similar level. It's almost the same. But anyway, the stock price has risen a lot at this point. I looked at the signals, and if you look at the data from the past 6 months, a buy signal came out here. The reason for the buy signal was that it was a good company, had strong growth potential, and the valuation was very undervalued. If you look below, you'll see that although the top moves much faster than before, when the supply and demand start to change like this, a buy signal appears. After that, the stock price rises step by step. The reason for the recent surge is that the stock soared the day after the earnings announcement. So, although the earnings themselves aren't extremely surprising, it seems that the market is highly valuing the generator business related to data centers and those areas right now. I hope that by looking into these changes, searching for articles and so on, you can judge whether this company can continue to grow in the future and that this will help you with your investment decisions. As I said at the beginning, I'm not telling you what to do or making recommendations. I hope this helps you figure things out for yourself using the data, and since you have access to a lot of news and information, I hope it helps you make a comprehensive judgment. If this was helpful, please like, comment, and subscribe. Also subscribe to Mitam Television. Thank you.